So we have discussed till now the concept of working capital management, and with respect to working capital management, we now understand that a working capital management is a situation where you tend to strike a balance between profitability and liquidity. And what is this profitability? What is this liquidity? Profitability is to earn more and more profits. Liquidity is to make sure that the business has got sufficient cash available to pay off the debts as they become due. Now, with respect to the different ratios, we are now going to talk about another ratio, and that is called the sales to working capital ratio. We would try to see this example, we would try to solve this example and take things forward. So what does it say? It says management company extracts from the annual accounts. Year 1, the currency is in dollars, the sales, the inventory, finished goods is given, receivables is given, payable is given, the net working capital is given. Now what next is there? It says sales over net working capital ratio is 864,000 divided by 162,800. So sales to working capital ratio is 5.3071. Now the examiner says that what increase in the level of net working capital, that is cash, what increase in the net working capital, that is cash, is needed to support the higher sales if the sales are forecast to rise by 200,000 over the next year. Working capital to the nearest 100. Now, first of all, it's important to understand the question's requirement. It says what increase in the level of net working capital, that is the cash, is needed to support higher sales if the sales are forecast to rise by 200,000. Now, what we are going to do is that we are going to assume that this specific ratio of sales to working capital is going to remain the same. We are going to assume that this ratio of sales to working capital is going to remain the same. So let's just try to see what's going to happen. You're simply going to say, okay, 5.3071 is equivalent to sales divided by working capital. So if this ratio is going to remain the same, the sales is going to be what? The sales is going to be 864,000 plus 200,000 divided by working capital. And then we would say the working capital is going to be what? We would say the working capital is going to be 864,000 plus 200,000 . This is going to be 200,486. So if your working capital is going to become 200,486, you will be able to achieve this ratio of 5.3071. So when we talk about the increase in working capital that is needed, you would simply do it like this. You would say 200,486 minus 162,800. Hence, resultingly what happens is that you would say minus 162,800. Hence, it is going to be 37,686. What is it going to be? 37,686. So basically, 37,686 is what it is actually going to be. So we have calculated this ratio also, which is sales over the working capital. Let's move a bit forward and let's take things forward. Now there is a very important concept when it comes to working capital management, and that is called the concept of overtrading. From the perspective of the examination, this overtrading could be tested as a theoretical part of a working capital question, or this could be tested as an OTQ. So you need to be ready for this question, this area on this overtrading. Now what exactly is the overtrading concept all about? So let me just guide you. The basic concept of overtrading is that when your business expands a lot without a supporting increase in the capital. So like for example, if the sales of the company keeps on increasing, whereas the capital remains constant. I repeat, the sales of the company keep on increasing and the capital of the company remains constant. So what would happen? If the sales keep on increasing and the capital remains constant, resultingly there is going to be a situation where you would be funding this growth in the sales by the increased payables, and the increased payables mean increased cost of purchase, and the increased cost of purchase means reduced profitability. So generally speaking, what happens is that the overtrading is disastrous for any company, and as a company you should avoid overtrading. From the perspective of the exam, you could be asked to identify the symptoms of overtrading. You could be asked to discuss that how the company could avoid the overtrading situation. That is something that could happen. So what could be the symptoms of overtrading? Let's have a discussion about it. It says that symptoms of overtrading are as follows. Symptoms of overtrading are as follows. Number one, a rapid increase in sales revenue. So that's what I told you. There is usually a significant increase in the sales. There is usually a significant increase in sales. So there becomes a rapid increase in sales revenue. That's something that happens. And often a fall in profit margin as discounts are used to chase higher sales. So what happens is that you want to speed up your sales, and in order to speed up your sales, what you do is that you offer discounts. In order to speed up your sales, what you do is that you offer credits. So you do multiple things in order to speed up the sales. So what is actually going to happen is that you would actually be standing at a situation where the increase in the sales is going to be supported by what? Is going to be supported by the discounts that you offer to your customers, is going to be supported by the increased credit period that you offer to your customers. A rapid increase in receivable, why? Because you are extending the credit period. A rapid increase in inventory, why? Because in order to support that sales, you need to invest in the inventory. A rapid increase in payables, why? Because where is it all funded from? From the suppliers. You are obtaining longer credit from the suppliers, and obviously the suppliers are going to be charging more. And the rising bank OD, indicating liquidity problems. Worsening liquidity ratios causing significant increase in the operating cycle. So it's a complete cycle that's actually destroyed when the company goes for overtrading. And in simple terms, what is overtrading? Overtrading is a situation where what happens is that there is a significant increase in the sales of the business without a proportionate increase in the capital. Resultingly, you are relying on somebody else's money, you are trading excessively, and that is ultimately going to be a disastrous situation for the company. We move forward, and now we are going to talk about another area of this working capital management, and this is the concept of inventory management. Now, before I go on to discuss the inventory management and the different models, let me just guide you something that the working capital has got multiple components. Current assets has got receivable, current assets has got inventory, current assets has got cash. You have got the current liabilities, the current liabilities have got payables, the current liabilities have got ODs, etc., etc. Ideally speaking, what should happen is that every organization should try to make sure that it controls, it manages its components of working capital in such a manner that you have got a short working capital cycle. Now, what I am going to talk about with respect to this inventory management now is that there is something that you should know, which is when we talk about the inventory. I repeat, when we talk about the inventory, what happens is that the inventory could be categorized into raw material. The inventory could be categorized into the work in process. The inventory could be categorized into the finished goods. So there could be multiple ways of categorizing or classifying the inventory, which is raw material, WIP, finished goods, etc., etc., etc. Now, obviously, with respect to raw material, what would you try to do? You would try to make sure that this raw material transfers from warehouse to the WIP as soon as possible. it transfers from warehouse to the production or to the operation as soon as possible. And for the production, it goes into the warehouse. From the warehouse, it goes to the customers. That means it gets sold quickly. So that is something that you should as an entity focus upon. Now the problem that actually arises is that when you have got inventory in a stock for long term, I repeat, when you have got inventory in a stock for long term, so holding the stock actually has got some problems. Now what are the problems of holding the stock? So the holding of the stock has a holding cost attached to it. There is a long list of what is constituted in a holding cost, but just try to understand that having high levels of inventory means there is a holding cost, and one of the components of the holding cost is the opportunity cost of funds. So I repeat, one of the components of the holding cost is the opportunity cost of the funds. Generally what happens is that the funds are held for the entity for the long term, because if they are stuck in the inventory, ultimately you would be losing out the opportunities of raising the money, of generating the money, earning the money that you could have done by investing those things in the banks or other securities. So as an entity, what you should try to do is that you should try to minimize your inventory costs, minimize. Now, the problem that actually arises is that even if you're going to try and minimize the inventory levels, so what would happen is that there is going to be ordering cost that would increase. Now what do we mean by ordering cost? So that means, like for example, if you need 100,000 kgs of material in a year, and what you do is that you order only 5,000 kg at a time. That means every time you would place an order, you would have to incur transportation cost, handling cost, purchase order cost, the supplier filterment cost, bank guarantee cost, etc. Multiple things would be there. So it is apparently going to be non-efficient for the entity to make a small orders and make so many orders. So ideally speaking, what the organization should try to do is that should try to make sure that that if they try to avoid the holding cost, they should not end up increasing the ordering cost. So an organization should try to strike a balance. So when we talk about the inventory management, there is a very important concept, and that is called the concept of economic order quantity. Now what exactly do you mean by economic order quantity? The economic order quantity actually is one of the models that tells you the ordering size, which would lead to minimal holding and ordering cost. So economic order quantity, EOQ, is one of those inventory order size that leads to minimal holding and minimal ordering cost. How do we actually go about with this economic order quantity? So before that, I want you to be able to understand that the cost of inventory has got three components. What are those three components? That is holding cost, that is ordering cost, and the third one of them is purchasing cost. What is this ordering cost? What is holding cost? What is purchasing cost? Let's try to understand this. When we talk about the concept of holding cost, I repeat, when we try to talk about the concept of holding cost, the holding cost actually refers to what? Holding cost, here is a list in front of you. It's a warehousing cost, it's the insurance cost, obsolescence cost, and opportunity cost of capital. Means when you have got the inventory which is kept in a warehouse, the more the inventory that you keep, resultingly what happens is that the more warehousing cost, the more warehouse rent, more warehouse security costs, etc. That's what you have to pay. Then there is this insurance cost. You have an insurance for theft, you have an insurance for fire. There could be multiple costs that you could be incurring if the inventory levels are high. Then obsolescence cost. What do you mean by obsolescence? When the inventory is held, it may become obsolete if it is not used on time. It may become damaged. There could be multiple things. And another important area is the opportunity cost of capital. Now that's very, very important. What happens is that the opportunity cost of capital is your money is tied up in the inventory. The money is not gonna get multiplied by being tied up in the inventory. I repeat, the money is not gonna get multiplied by being tied up in the inventory. What would happen is that your money is losing out its value. You could have earned potentially interest income on the money, but you cannot earn that income right now. The reason being your money is stuck up in inventory. So as an organization, what you should try to do is that you should try to reduce your holding cost. I mean, you should try to reduce your holding cost. And then you should try to reduce your holding cost. So as a result of this, what you should try to do is that you should have less investment in inventory. The second component is ordering cost. So every time you place an order, the inventory is delivered to you, you have to bear a certain cost. So the certain cost that you have to bear, that's called ordering cost, and it has got multiple things: cost of administering orders, delivery costs, so and so. Right? For example, if you have to make an order, there are many components to it. You have to choose the supplier. If you have to make an order, there are many other components, like as I said, you have to choose the supplier. You have to choose you have to choose the supplier, you have to filter out the supplier, you have to make sure that the goods are delivered to you, the delivery cost has to be paid, plus the inspection cost needs to be incurred, plus other costs like transit insurance, etc., etc. There are multiple costs that are attributed to every single time the goods get delivered to you. So every single time the goods get delivered to you, resultingly what would happen is that is the ordering cost that you would incur as an entity. Now what should you do? You should try to make sure that the ordering cost is minimized. How is the ordering cost going to be minimized? When the order size is gonna be high. If your order size is gonna be high, the ordering cost is going to be minimized. The order size is high, the number of orders goes down, and when the number of orders goes down, automatically you have got less ordering cost. Lastly, the purchasing cost. So the purchasing cost is the cost that you pay for the purchase of inventory, which is reduced by multiple things, and one of them is the bulk purchase discount. One of them is a bulk purchase discount. I repeat, one of them is a bulk purchase discount. There is actually a formula for the economic order quantity, because from the perspective of the examination, you are being asked multiple things to do. And what are the multiple things that you are being asked to do? You are being asked multiple things to do, which is to calculate EOQ, which is to calculate holding costs, which is to calculate ordering costs, etc., etc. So what you should do is that you should know that there is a formula for the calculation of economic order quantity. This formula is also given to you in the examination. It says that you have to know the components of the formula. The formula is given, but you should know the components of the formula. So when I talk about the economic order quantity, the components of the formula are the number CO. CO is cost of placing an order. The cost of placing an order, a single order, the cost of placing a single order is gonna be considered as cost of ordering. Then you have got D. D is gonna be your annual demand. What is it gonna be? It is actually gonna be your annual demand. So the D is gonna be your annual demand. And then you have got CH, which is cost of holding one unit of inventory per annum. The cost of holding one unit of inventory per annum. So like if you have got one single item of inventory which is being held for 12 months of the year, how much is the cost that you are going to incur? That is called cost of holding. That is called cost of holding. So the formula for this EOQ is that it is 2 COD. I bet the formula for the EOQ is that it is 2 COD divided by CH, and this whole is under root. I'll take an example of the economic order quantity and we'll discuss this example, that how to calculate the economic order quantity in Excel. It says the demand for a commodity is 3000 units a month. So that means if I try to calculate the annual demand, it is going to be 3000 into 12, which is 36,000 units at a steady rate. It costs $20 to place an order. So the cost of placing an order is $20 and $0.5 to hold a unit for a year. So CH is going to be $0.5. CH is going to be $0.4, sorry. Now how exactly are you going to do this? So the economic order quantity is going to be 2 into CO, which is 20, into D, which is 36,000, divided by CH, which is 0.4. And you got to put the whole of it under root. So resultingly, what are you going to get? You're going to get the cost of the economic order quantity, which is going to be 2 into 20 into 36. Hence, it is going to be 1897.4 units. So that means every now and then you got to place an order for 1897.4 units. I repeat, every now and then you got to place an order for 1897.4 units. What? You got to make an order for 1897.4 units. Now, this is another example, and through this example we will discuss another concept with respect to EOQ calculation. So let's just try to take this example so that I can explain to you the concepts. It says firm X faces regular demand of 150 units per month. So 150 multiplied by 12, which is 1800. So this is 1800 being the annual demand. It orders from its supplier at a purchase cost per unit of $25. What does it do? It places an order for $25, means cost of purchase is 25. Each order costs $32 and the annual holding cost is 4.5 unit per unit. Requirement is calculate the economic order quantity and the average inventory level. Now that's a very important concept that we're going to be discussing over here. First of all, I'll make things easy for myself and for you people. I'll do the calculation of EOQ, which is going to be 2 into CO. What is the cost of placing an order, which is 32, and then there is this demand, which is 1800. You divide it by CH, which is 4.5. The whole is under root, and then what are we going to get? It is going to be 160 units. So what is it actually going to be? 160 units. So the EOQ is 160 units. Now, a very important concept is that how would you know the average inventory level? So I want you people to understand the concept of this average inventory through the example over here, because this is an area that is examined on a lot on multiple occasions, so you should know. When I talk about the average inventory levels, what is actually going to happen? Try to see, assume that this is your inventory. Assume that this is your inventory. Now what's going to happen? What is actually going to happen is that you consume inventory, consume. It reaches, let's say, 0 level, and then you replenish the inventory. You consume. You reorder, it gets replenished. You consume, you reorder, it gets replenished. You consume, order, replenish. Consume, then replenish. Now, what happens is that assume that this is 1000. Let's say 1000 units. Assume that this is 0. So what would happen is that your inventory is fluctuating between 0 and 1000. I repeat, your inventory is fluctuating between 0 and 1000. So if your inventory is fluctuating between 0 and 1000, so the average inventory is going to be, I repeat, the average inventory is going to be in between them, is going to be somewhere in between them. So ideally speaking, what happens is that when you are establishing the average inventory level, the average inventory level is your simple order quantity divided by 2. Order quantity divided by 2. So in this scenario, if I have to calculate the average inventory level, I would say average inventory is 160 divided by 2, means 80 units is your average inventory level. How do you calculate the average inventory level? It's the order quantity divided by 2. Now let's just try to understand something more also, which is, I've discussed this thing with you. Now let's try to understand something. So we have discussed the concept of average inventory level. Now let's move. When I talk about the average inventory level, it was order quantity divided by 2. At times the organizations, they have got buffer stock also. Buffer stock is, they put some minimum stock. They put some minimum stock, that's called buffer stock. So when you put some buffer stock, so your average inventory is going to be buffer stock plus order quantity divided by 2. Your average inventory is going to be buffer stock plus order quantity divided by 2. It's going to be average inventory is buffer stock plus order quantity divided by 2. So now, here the examiner had a requirement, calculate economic order quantity, we are done with it. Average inventory level, we are done with that also. Now he says calculate total inventory related cost at this EOQ. Calculate total inventory related cost at this EOQ. So I'm going to guide you people through that how would you calculate the total inventory cost. So when we talk about the total inventory cost, it has got 3 levels. What are the 3 components of the total inventory cost? One of them is called purchase price. The second one of them is called holding cost. And the third one of them is going to be the ordering cost. So your purchase price, how would you establish the purchase price? We had a total inventory requirement of 1800 unit. 25 was the purchase price per unit. So it is simply going to be 25 into 1800. Hence, resultingly, this is going to be 45,000. Then you have got holding cost. The holding cost is what? 4.5 per unit. So always remember the holding cost is going to be applied on average inventory. How much is it going to be applied on? Average inventory. So average inventory is that order quantity divided by 2 multiplied by 4.5. So hence what happens is that this is going to be like this. This is going to be like this. The order quantity is how much? The order quantity is 160. You divide by 2 multiply by 4.5. Hence this is going to be 360. And lastly, when we talk about the last one, what is going to be the last one of this is going to be? The last one is going to be the ordering cost. The ordering cost is obviously you get the annual demand divided by order quantity multiplied by. The cost of placing each order is 32. So basically what is going to happen is that all that you need to do is that you need to say it is going to be the annual demand is 1800 divided by 160 multiplied by 32. Because when you say 1800 divided by 160, it gives you the number of orders. So 1800 divided by 160 multiplied by 32, it is going to be 360 again. And as I did tell you, basically, okay, so what we have got is we have got 45,720. Now, you could see one thing, which is the ordering cost total and total holding cost is the same. The total holding and the total ordering cost is the same. Why is that so? So always remember this thing, that always remember this thing, which is under the economic order quantity model. I repeat, under the economic order quantity model, the total holding cost will equal total ordering cost if there is no buffer stock. It will always be the case. That when it comes to the economic order quantity model, if there is no buffer stock, the total ordering cost would be equal to total holding cost. The total ordering cost would be equal to total holding cost. That's what it is going to. Now, we're going to move a bit forward and we are going to discuss the final aspect, which is the concept of this thing, which is the drawbacks of the EOQ model. Obviously, every model has got certain drawbacks, and the economic order quantity model also has its drawback. So you have this slide in front of you, which is discussing about the limitations of the economic order quantity model. And if we go through them, you would see that number one is that it assumes zero lead times. Now, what do you mean by lead time? Lead time actually refers to the time taken to deliver goods from the date of placing an order. So the time at which you would place an order, from that time till the time the goods are delivered, whatever time that it takes is going to be considered as what? Lead time. So economic order quantity assumes zero lead times, which is unrealistic assumption, because no matter what happens, the lead times can never be zero. I repeat, no matter what happens, the lead times can never be zero. And it assumes no bulk purchase discount. You know this thing for sure. When you make a purchase of a higher quantity, there is going to be discount that would be available. It says it ignores the need to increase order sizes if there is a possibility of supplier shortages. So it's a model, right? Every model has limitations, and same goes here. Like, what would you do if the supplier says, look, place your order as soon as possible because the inventory is going to run out very soon? What would you do? You would increase the order quantity. But here in this case, it does not happen like this. What it does is that simply the economic order quantity ignores. It says that the order size would be the same irrespective of whatever the circumstances are. The fluctuations in demand are ignored, and ignores the benefit of holding inventory to customers, and ignores hidden cost of holding inventory. So there are hidden costs of holding inventory also, which are also ignored, because it only considers those variable costs which are incurred. It does not cover all the costs. So EOQ model has got limitation, but again, it's one of those models that's in use by a lot of organizations. Why? Because it gives the basis as to what should be the order quantity. There's last one aspect with respect to the inventory management, which I'm going to discuss. And that is, at times what happens is the examiner gives you a scenario where he goes about discussing the bulk discounts. Now when we talk about the concept of bulk discounts, so what exactly do you mean by bulk discounts? It means if you place an order of 10,000 units, we will charge you $5 per unit. But if your order are 10,000 unit plus, we will give you, let's say, a discount of 4%, 5%, etc., etc. So in case if the examination, from the examination's perspective, if you are being given such a scenario where the examiner says that, look, you will be offered a discount if you do this, you will be offered a discount if you do that, etc. So what are you going to do as an entity? You're simply going to do this thing. You're going to say, okay, let's compare. If I adopt the EOQ order size and if I adopt bulk purchase discount. So what you would do is that you would compare the purchase price, total holding cost, so when you would have such a situation, it's simply gonna be what? It's gonna be a comparison. You would compare the cost, the total cost that you incur when it comes to EOQ order size and the total cost that you would incur when you would be purchasing bulk. Whichever is gonna be a low cost model, obviously you're gonna go for that. So that marks the conclusion of the conceptual understanding of the inventory management. And I hope that you people would have understood this. Now what we would do is that we would go about doing some questions on this in our next, the next that we continue, we're going to talk about the questions on this.